Hello, everybody, and welcome to another episode of our Southern California housing market update. This is for July 19th, 2022, over halfway through the year. And again, this market kind of continues to surprise us, experts and consumers alike. I'm your host, Stephen Meade with Domicile real estate for people who love houses. Let's get started. And before we jump into the slides, something fun I want to talk about. I always mention when we talk about closed data that it's 4 to 6 weeks old. A couple of you have commented on that. Why is that? Isn't there a way to get more accurate data? And, today I was kind of reminded of something, in that kind of same vein, and that is that several news outlets are running articles that the housing market has really slowed down. And while I would say the market is absolutely different than it was 3 months ago, that's sort of old news. That's sort of 4 weeks ago news. This week's news is two admittedly attractive properties that got a lot of interest. Both of them are going for several $100,000 over list price with over 20 offers on them. So, the rates kind of went up, peaked, and then came back. And I think what we're seeing is consumers are backing away from that sky is falling kind of a model. And they're really kind of ready to sort of jump back into things. So I think if we had sort of a lull where it was really slow, I think that lull is kind of over. I am, again, though, seeing that really wide disparity between the most desirable and attractive properties and sort of the least desirable properties. And I'm going to talk about that when we go into sort of our price graph here, because I think there's some interesting things happening. But let's not delay anymore. I want to go ahead and run this in here. Go back to the beginning here. So the first thing is active listings, and really some great news on this front if you are a home buyer, right? If you're a home seller, maybe this news isn't as great to you, but if you look at where we were a year ago today, right? We had about 3,500 active homes between $1 and $2 million and 6,000 under $1 million. So that total, or rather, this is 3,000 and 6,000. So that's 9,000 homes, total at that point in time. Right now, we've got 8,000 under $1 million. That's a 33% increase. And maybe here we're about 1,100 higher. So maybe that's actually, again, probably about the same level of increase. So our inventory is up by 33%, but I'm not really sure what the quality of that inventory is. And I'm going to explain where I'm going with this and why. So if we look at our new listings in the last 14 days, really, these numbers have a maybe ever so slight downward taper. We're seeing kind of some fluctuations here, but what was around these time periods, holiday weekends, those always kind of throw things off. So we've actually seen kind of this new listing activity pretty steady. What we're not seeing, though, is new listings are at a level, let's see, for 1 to 2 million, the same as last year, but significantly less, about 25% less for our under 1 million. So listings are down, but they're not down by enough. And that's the reason why inventory is going up over last year. So that effect of fewer listings is not completely counteracting that effect of fewer properties going into escrow. Here's our last 14 days of new escrows. And as you can see, we're a little bit down on our 1 to 2 million properties. And we are down again by over 33% here on our 1 to 2 million or under $1 million properties in terms of new escrows. What do we think is really happening on this? Obviously, affordability is a major factor, but I think there's kind of a secondary factor going on here. And that secondary factor is, I think buyers are a lot pickier. I think there has been just a huge shift in buyer mentality. And I want to address this because I think this is probably the most important thing to learn, right? Is 6 months ago, buyers were happy to get anything, right? It didn't matter. A 0-bedroom, 1-bath house, they were excited. Buyers today, they want to see houses for a second visit. We're seeing that homes, just that period of time, that sort of cadence of a new listing comes to the market, even when it's popular, agents are allowing more time for people to look at that property in general. So it's definitely a huge shift. Jumping back in here, these buyers, they're out there, but like I said, I think they're a lot more careful about what they're willing to buy. So if you've got a property that's at that sort of bottom end, that's really going to be a harder sell right now. Whereas if you've got a property at the top end, people still want it. We've been saying that for a while. So if we look at our absorption rate, right, under $1 million, right about 60%, that is a very slightly tilted seller's market. And 1 to 2 million, that's 50%. That's really squarely in that sort of more neutral market territory. But this is the graph that I wanted to point out. So this is closed prices. And what we've done with this, just as a reminder for everybody, is we've divided this by the 25th percentile, which is sort of the bottom quarter, the median, which is the middle in terms of price, and the 75th percentile, which is the top end. Now, what do you really notice here when you look at this chart? Well, at the bottom end, I see maybe an ever so slight downward bend to prices, maybe, right? I mean, if we look back in this period of the end of March or even the middle of April to now. If I look here in the median, what do I see? I actually see that prices are higher, than they were from that area, or about the same, right? At pretty much flat. But up here in the 75th percentile, we see a little bit more softness. And I think the super, super rich properties, those are a whole different market, right? That 95th percentile. But this sort of like luxury, but not quite wealthy market, I think a lot of buyers in this market were coming from stock market earnings, crypto. I think they really felt wealthier than they were, and they were willing to spend up to get houses. Now, I do want to make an important distinction here. If you look at this chart, where are we today, right? Well, we're about a third of the way between 1.25 and $1.5 million. But that's still significantly higher than we were back in February of this year, right? I mean, that's still a good, 5% plus higher than we were in February of this year. So I see a little bit of a downward trend. I'm kind of curious whether that's going to continue. Stock market and Bitcoin are recovering. So I kind of want to watch this space in the 75th percentile market, but I think it's amazing just watching how resilient these 25th percentile and median markets are. I feel like if we were going to start seeing big declines, we would have started seeing them by now. As right now, anecdotally, it feels like the market's picking up. Open houses are busier. If we go on here to our percent still active after 14 days on market, yes, these numbers are still high at 85%, right? But look what's happened is I definitely feel like this is kind of turned over a little bit. We'll have to see whether this decline really continues on for another week, but it definitely feels like the market is a little bit different than it was in the past 2 weeks. Here really is kind of the sort of the come to Jesus moment, if you were, right? And this tells me that our market is adjusting. Now, I'm gonna pose a rhetorical question for you. If we go back here and we see that the prices are either flat or a slight downward movement, but we go back here and we see that our close versus list ratio is now down to 102%, which is something that we talked about, a direction we thought it was going to go. What does that tell you? Well, it really tells me two things. It tells me that A, the obvious, right? Consumers are not willing to go as far above list price on average as they once were. But what else this tells me is it tells me that prices that sellers have asked for have jumped considerably and the buyers aren't having it. So one of the things we've always talked about, what does this close versus list price really mean? What this is measuring is the difference between what sellers think their home is worth and what buyers are willing to pay. And when you get over into this zone here, this over 106%, 108%, and that 1 to 2 million category, what does that mean? It means buyers are crazy for homes and sellers don't think that they're worth as much as they do. Down here, this is different. This is much closer in alignment. These sellers but we haven't seen the prices drop that much. So what does that mean? It means that the asking prices have gone up considerably And consumers have met those asking prices, but they haven't just jumped forward by several percentage points. They haven't been able to say, we're just going to write offers for 5% over anymore. Here's our days on market. And this is another one that I think is kind of interesting to me, because we hovered in this below 20-day sort of wasteland through the spring. Rates started going up. And remember, this is days on market for the homes that are in escrow. So this is a subset of the market. This is the ones people are actually buying, right? Well, if we look at this chart here, we see things ratcheted up, and then they've started to curve downward just again, right? And what does that tell me? It tells me that the good houses aren't sitting on the market. People know the good ones when they see them, and they're still buying them. That gestation period has gone up a little bit, but in the grand scheme of things, we're under 30 days on all of these. These are not long marketing times for these homes that are finding the buyers. And now we come to our three-way. We got some new CPI data. Shocking news, CPI index went up, right? Since 2018, it is up roughly 20%. And nearly all of that has happened kind of in the most recent periods. It kind of jumped up there and then has just been steadily going upward like this. But again, we're tracking this graph, and what does this tell you about rents and home prices? Well, they're kind of finding their new happy equilibrium and stability point. You saw things ratchet up, and then here things are kind of staying in this same zone without huge movements. I think that's really important to understand. What kind of a market are we in? Are we in an adjusting market? Or are we in a fairly stable market? I think we are trending towards stability at this moment in time. And then here is our prevailing 30-year fixed rate mortgages. They, of course, shot up. We all know what happened. They took a break, then they shot up again almost to 6% and came down a little, have recovered. And I kind of feel like the market might be finding 5.5%. Obviously, we've got a Fed meeting coming up. Rumor is on the street that they're going to go for a full 100 basis points. You know, your guess is really as good as mine. I think most economists want them to go up by that much or even more. I think the general consensus among economists is that our economy is overheated and that we are going to have to deal with that if we want to rein in inflation. But you know, as of right now, I attended kind of an economics talk last week, and one of the distinctions that economist made was talking about this notion of, are we in a recession? Right, we had a quarter of negative GDP growth, or are we stalling? And those are very different phenomena. A recession is when your economy is retrenching backwards. A stall is almost the opposite. It's when you've pointed your nose too high, you're trying to go too fast, and you're not able to sustain it. And I think that is actually a very different phenomena. He believes we are in a stall at the moment. And what is causing this stall? Not enough labor, not enough raw materials to make the goods and services that are being requested by the economy, and that's really what's driving inflation. Is a sign of a stall, not a sign of a recession. So, kind of some interesting things to think about to see whether the Fed's going to move that. Regardless, you know, I think housing is generally in a good position. The question is, are we going to just see runaway inflation that will lead to double-digit interest rates? I don't think so, but I absolutely think interest rates could go higher than they are at today. How much higher? Who knows? Anyhow, thanks so much for watching. Questions, comments, we love them. Do not forget to like, subscribe, and hit that notification bell. And if you or someone you know is looking to buy or sell real estate in Southern California, we would love to lend you our expertise. There is a link down below for a no cost, no obligation, 15-minute consultation via Zoom. We love doing those. Kind of a great chance to ask questions. I'm trying to think what else. Well, we're going to see you again later this week for an architectural video. So we'll see you again real soon.